You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again for Education Wednesday here on the Options Insider Radio Network. That means it's time once again for your premier options educational program. It is time once again for Options Bootcamp. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-compelling, at least we tend to think so, Options Insider Radio Network, reminding you coming at you with many more shows than just Options Bootcamp. So if you're not listening to, for example, OPR, the sister program to this one, coming up later today on Education Wednesday with Brian and the folks over there at Ally, then check that one out. And, of course, all the rest of the shows coming at you usually twice a day here on the network. And, of course, if you want to go above and beyond and join us on the live streams and get access to exclusive shows like Options Oddities every week, where we break down a lot of unusual options activity. And, of course, great Options Pro Q&As. Just had Scott Nations on the Pro Q&A hot seat yesterday answering all of your questions about volatility and all sorts of fun stuff. Then you know where to go. theoptionsinsider.com/pro is the place to go to learn more. And, of course, if you're listening on demand after the fact, like many of our on-demand listeners, all we ask, you keep rating and reviewing. It really does help all the new folks continue to discover the content coming off the hottest month in the history, the 15-plus year history of the network. So you folks are clearly enjoying the content and leaving a plethora of great reviews, just like our 5-star review this week coming from Jace. Jace just says, he's a man of few words. He says, cool show. Thanks for all the great info. Well, you're welcome, Jace, and you're welcome to everyone else out there who's enjoying the content. And if I sound a little bit different, listeners, it's because I'm not coming at you from our studio, but studio adjacent. We're right down the street here, actually at the new Cboe headquarters. We're bursting in on our black-hatted friends Mastermind session, because I'm joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back, sir.
Hey, Mark. Great to be here, and looking forward to doing this live. We haven't done this live together in a long time.
Years. I'm trying to think when the last time you and I were in the same room together.
Yeah, I was in your studio, I bet it was at least 2 years ago.
Probably pre-pandemic, I would imagine.
Yeah.
And we're going to be doing it again, I think, in a couple of months, right? And the folks at Harvard roped us into doing a panel, right?
Oh, you're going to join?
I'm going to be there. You twisted my arm.
That's awesome. Yeah, that's going to be fun.
So, yes, Dan and I will be holding court for the Harvard Business School in a couple of months. So check that out. We'll probably see if we can get that to the network. No guarantees, listeners, but we'll see if we can get that out for you. All right, then, with the team assembled, including our live listeners, we'll see if we can corral some live mail call today. It is time for a live edition of the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, buddy. Welcome to the mail call segment, the portion of the show where you folks take the reins, your questions, your comments, your insights, your pearls of wisdom. We also turn the spotlight back on you like we're going to do this week. Let's kick it off. Maybe we'll get the pulse of the room on this one as well. It'll be kind of fun. Our question of the week this week, listeners, is VIX. VIX is back below 20. Is this the beginning of a new volatility regime or just a blip on the radar? Quite simply, will VIX still be below 20 at the end of Q3, so the end of September, listeners? I gave you three choices. Yes, no, or the infamous third choice, which this week's is VIX is confusing. So looking at the numbers right here, I have them in front of me, but let's go out to Mr. Dan first. Dan, what are you feeling? And then what do you think our audience is feeling? Are they saying, yes, we're going to be back below 20 by the end of Q3, or are you going to be, no, we're going to be above 20, or are they just completely confused by all things VIX?
Here at the Mastermind, we were kind of talking a little bit about just the economy, macroeconomic factors and such. And it's always tough to say. But you know what? Wait, what was the comment and whose was it? Was it was it Rob's? I've never met a rich economist, right?
They do call it the dismal science for a reason, yes.
But that being said, I'm compelled to feel that it's a little bit of a blip on a radar. I think it could last a little bit, but I think just with everything going on, I don't see us coming out rainbows and unicorns within the next 3 months either.
So you're saying it is no, and you think the audience is going that way too?
Yeah, I do.
You do? Okay, let's get a quick poll of the room. How many of you think VIX will be below 20 at the end of September, end of Q3? Raise your hands if you think it will be below 20. One person.
Wow.
All right. I'm assuming everyone else is no, or are you in the VIX is confusing? Raise your hand if you know. We got one no. Okay, there we go. All right, there we go. Now you were confused about the question. There we go.
And remember, this is Chicago. You have to vote at least once.
At least. Vote early, vote often. Well, our audience agrees with you guys. They say about exactly 2/3, 67%, saying that we are not going to be below 20 at the end of Q3. 18.2% saying yes, and 14.8% saying VIX is confusing, which I guess in this environment, I could see why you might want to put that one down. We are in some interesting times. Remember, you have until the end of the week, listeners. It is our question of the week at Options is the place to go to make your voice heard. Let's pay off a couple of questions we talked about on the show last week, Dan, and then we'll get some of the live questions here. Last week, we asked you guys, volatility has many different causes. However, which of the following factors do you feel is the primary driver of the current volatility environment? Gave you three choices in the infamous other: earnings season, the Fed, Ukraine, or other. And Dan, I believe you chose the Fed on the show last week. Our audience agreed with you. 62.5% came in favor of the Fed. 25% saying other, but only a handful giving us their actual other. If you say other, we even say in the link, explain yourself. I want to know, what is your other? Maybe there's some weird other floating around out there that we have not encountered yet. So 8.3% only going for earnings season, 4.2% going for Ukraine. And perhaps even more relevant for this audience here today, because I know you guys were doing some rating before I walked in. Our question of the week last week, we actually had a rare twofer last week because so much was going on last week. We asked you, we've seen an explosion of call options paper in names like GameStop, AMC, BBig, Bed Bath & Beyond, AMC, and others recently, which raises the question, is the meme stock frenzy back? And Dan, I think you said no. Our audience, though, first off, let me ask you guys before I reveal the answer. If yes or no, do you guys think the meme stock frenzy, the call frenzy, is back? Raise your hand for yes. We got one. Just one? Okay, one. So no. Oh, you're yes? Oh, you're back on yes. You're changing your tune. All right, so we have two for yes, and then all the rest are no or abstaining. All right. We've got some shy folks here. We'll see. We'll wake them up, listeners. Don't worry. All right. So yes, well, we have our audience agrees with you almost overwhelmingly. Almost 70%, 69.3% said the meme stock frenzy is back. 30.7% saying no. So intriguing stuff. Dan, does that line up with what you're seeing out there on your rating screens these days? I mean, outside of the crazy Bed Bath & Beyonds and the Coinbases, are you seeing this kind of stuff lighting it up again?
Yeah, we are. You know, I would argue that the short squeeze play never really went away entirely. It did get a little softer. You know, we didn't see as many signals, but we've been seeing maybe not as many individual names pop up on our radar, but a lot from each individual name. Like we've seen some very, very strong signals in Bed Bath & Beyond, in GME. We did see some in BBig, and we saw Canopy Growth pop up today, which was interesting.
Yeah, Canopy. That whole sector has been hot and cold of late, so maybe get a little hotter again. We shall see. One of them, what was it? Sundial just did a massive reverse split, right? So they're seeing, trying to get some liquidity back in that space after it's been dried up. We have a bunch of listener questions here, but again, if you guys have some live questions, feel free. Don't be shy. All right. Let's go out to Angelo's got you guys beat. Let's go out to Angelo first. Angelo says, dovetails perfectly what we were just talking about with the meme stock frenzy. Angelo says, do you guys think the memes are back? And why do you think so many traders can't stop buying this market? Well, I was talking on the show last week. I think some of those results of that poll are a little bit of hopium. People want it to be back, and why not? It was a crazy time. It was a hot time. Everyone and their mother and their grandmother's cousin were all trading options. It was insane. I mean, Dan and I have been doing this for a while. I can't recall another time where options had so permeated the commonplace vernacular. I mean, everyone was talking about, and not usually when that happens, it's in a pejorative sense. Some crazy scandal happened, and everyone was, it's very negative. This was not the case. Everyone was talking about options. They loved them. They were on TikTok and Reddit and you name it. And it was just a hot, crazy time. So I can see why people maybe long for that a little bit, especially when we're seeing some downturns in the broad market. The days when everything went up and all you had to do was buy a call and you made $1 million. Who wouldn't long for those days again? So I think there's some hopium to that. So I don't know if I'm fully on board with the memes are back. I have said on some of our shows, like the Option Block and Options Oddities, where we scan a lot of unusual activity, that we are starting to see more of that style of paper come back. It took a hiatus for the better part of this year. It was mostly a lot of downside puts for reasons you probably could imagine. Most things were trending lower. But you are starting to see some of that, what I would call meme-style paper come back, where it's names, maybe they're heavily shorted, maybe they're just cheap names, and people are coming in, scooping up a lot of what I would define as meme stock paper, is very near-dated, far out of the money, upside call paper, usually with a triple-digit or higher volatility level. If you have all three of those things, those tend to, in my mind at least, qualify for the meme stock palooza. So I would say we are starting to see more of that. Dan, you just voted yes. You think it is back. So what do you have to say for Angelo here, who wants to know, I guess you answered the first part already, do you think the memes are back? But also, why do you think so many traders can't stop buying this market, sir?
Well, to me, the interesting thing about the market is that it's one opinion versus the other. You're voting with your dollars or your contracts, I guess you could say. And so, when you see some of these stocks, and there are a good handful of them out there that are shorted reasonably heavily, which we're just talking here in the Mastermind that I define as 15% or more of the float being shorted. That's a lot of short interest. But when you dig into the numbers and you see these companies and they have growing revenues, growing earnings every quarter after every quarter, and bottom line, net income growing, why is this company being shorted? And a lot of times you find that maybe they shouldn't, and those are the ones that are special. Those are the ones that, if it's a quality company that's sort of what I would call overshorted, and people are talking about it on Reddit, and we're seeing all this call buying happening, which I define as greater volume than the amount of current open interest happening in a single day, then it can end up this really perfect storm, this real sweet spot where everything just lines up and it becomes a great opportunity. And we saw that this week with Bed Bath & Beyond.
Yes, we did. Interesting stuff there for Bed Bath. Good question there. Who was that? Angelo. Let's go out to Nino. Got a lot of vowels on the show today, Dan, so that should make you happy. Nino says, what is the right amount of options? This is an interesting question. What is the right amount of options trades that a newer trader should be looking to do every week? Well, Dan, don't you teach in your classes that if it's not 17 trades a week, you're doing it wrong, right? Isn't that the first step in the MTM instructional manual?
Yeah, we actually lowered that to 16 trades, but yeah, exactly.
I'm behind the updated curriculum there. But yes, you're very demanding over there as a teacher. But yeah, who is this? Nino, yeah, there's no one amount. I mean, it sounds like you say you're a newer trader. You don't really define what that means, how long you've been trading options, what you're used to, what you traded before. I'm assuming probably stocks, but there is no, I think probably if you're newer, the fewer the better, especially weekly. This guy's really looking to dive. He wants to do X number of trades a week. You might want to think maybe X number a month, put on a call, see how that works, and then let that go, and then maybe try a call spread, and then maybe you go from there, maybe a covered call, one at a time, and take it slow. Dan, when people come to you, they're champing at the bit. They're looking to explode out of the gate, doing a lot of trading very early. What do you usually tell them?
I do these daily videos, and I just did one on this exact thing, I believe this past Friday, on over trading. Look, it's not about the number of trades that you trade. It's about trading only the good trades. And there are a lot of days when there's a whole bunch of good trades. And you might make, even as a new trader, 4 trades in a day maybe. But then there's sometimes when either the market's slower and things just aren't moving, or maybe it's too crazy and you want to take a step back, and maybe you don't trade at all that day, or maybe you'll only make a couple trades that week. So I like to encourage people not to focus on trying to hit a certain number of trades, but instead to really comb through all the possibilities and find just the best ones and attack those opportunities when you find them.
The answer is 17. Yeah, 17 a week is how many you should be doing. And if you're doing less than that, then you're doing it wrong. You need to contact us post-haste. We're on the horn real quick. Everybody waking up? Anybody got any questions that are percolating top of mind? Now is your chance. Yeah. Anything, sure. I guess within reason. Go ahead. Oh, well, he wants that question. He wants the $10 million question. I guess that's a kind of related way. By the way, the question, listeners, if you couldn't hear it, was he wants to know, where is SPY heading? So I'm going to bust out my crystal ball here. So there's a lot of corollaries to this question, right? Do we believe this rally? What is the options flow telling us out here? And there's a couple answers to that. First off, I've been surprised. I think a lot of you have. I've been surprised. I mean, I won't speak for Dan, but maybe I'm assuming Dan has as well. I've been surprised. A lot of the guests that we brought on our network over this past week have been surprised by just the breadth of this rally. A lot of people thought when we got down to 3,600 level or so that maybe it was a bit oversold in the near term. We might see a little bit of a bounce. I don't know a single person who had 4,300 in the span of a month in their crystal ball. If they did, I needed to talk to them. So I've been a little bit surprised. So right now, I'm looking at this as kind of a, we're flirting around this 4,300. We flirt north of it. We dip past south of it again. I'm not feeling, and I haven't been for a little while, I'm not feeling a lot of optimism. When people come to me now and say, hey, should I load up on a ton of SPY? I tell them, well, if you didn't get in at 3,600, maybe keep some powder dry here a little bit. This is an interesting opportunity looking at things like we talked about on the show before, a short put spreads. So if you identify a strike that you like, let's say maybe SPY, you want to get back in below 4,000 again, maybe you're not going to get a lot of premium for the 3,600 strike right now, I don't think. So if you try to sell around there, unless you go farther out than I'd be comfortable, you can always do this put spreads too, buy one, sell one, buy one, sell two, getting into that. So maybe you buy around the 4,000, sell two around the 3,700 level, and now you're legging into a put spread that has some momentum. And also, if you get down to that level, it's a cheaper put spread because you're selling to, and you actually can pick up the underlying at that level that it gets down there again. But there are so many headwinds to this market. I mean, earnings are still kind of blah. People seem to have forgot. We were talking about it yesterday on the network. People say don't fight the Fed. I guess that applies unless you don't like the fact that the Fed is raising. Then you're just like, whatever. Then you fight the Fed all day because everyone's been buying this market in spite of the fact that we're looking at 0.75 of a point pretty much at every meeting going forward. And also, if you look at the VIX curve, another thing that gives me a lot of pause, the VIX futures curve, it's bid up to the midterm elections. I think that makes sense. People are concerned about the midterm. Usually every big election cycle, we see that happening. That's not surprising. But usually it comes off after that. And it's not. It's actually trending beyond that. If you get into the end of the year, it's around a 28. You get into Q1 of next year, it's north of 28 for a lot of those front futures. And that's pricing in a lot of juice and a very steep contango. And that also shows to me that in spite of what we're seeing right now, there are headwinds to this market that people are pricing in and a lot more longer-term vol. I mean, how do we get to a 28 vol in Q1 of next year if we don't see some sort of downturn, you would think, right? So it has to be pricing that in. So I guess that's a lot of factors to throw at you, but a long way around to saying I am uneasy at these levels. I'm not putting a lot of capital to work at, let's say, S&P 4,300. It's in single names. I've been attracted by a lot of single names that have been beaten up. Names like Ford got down there. I sold some 12 puts in Ford not too long ago, and I was wearing it for a while. And I was like, wow, maybe I got ahead of myself. Now those look pretty good. Again, if you identify levels where you don't mind buying the stock, the risk management is kind of involved in the trade. But broad S&P, yeah, I'm kind of leery here. Dan, I don't want to speak for you, sir. What are your thoughts on S&P here?
Yeah, we were talking about this a bit earlier as well, and just talking about kind of to pile on a little bit to what you were talking about. So it takes 6 months to a year for any Fed policy to actually make its way into the economy. But that's the economy, and the market is different than the economy. They're two different things. And so, Rob was saying earlier that, maybe the market is looking looking ahead, looking past the recession that can happen. Depending on what definition of recession we want to use.
Technically, we are in a recession. Right? And no one seems to want to say it officially, but technically, in the dismal science books that I had in school, we are technically in a recession.
Right. So it's like, are we ahead of the curve? Is there just some irrational exuberance, if you will? And it's tough. It's really tough. For a while, when we did sort of hit the bottom, I did talk a lot about how we had some room to the upside, but then a week or maybe about 2 weeks ago, I started to back off, and I said, okay, this bounce off the bottom, I could see that happening. And now I don't know. It's really, really tough.
Intriguing stuff like this we've kind of been polling a lot of our audience about that exact same question, as you might imagine, for a while as well, trying to get the pulse of them. And they've been fading this rally for a while. Our audience is extremely bearish on this. And so maybe read into that with a little bit of a grain of salt, because if you've led into all that, you missed the big gap up. But it has been, there are a lot of people out there and a lot of vol. Again, and looking at the VIX, I look at the VIX futures curve even more than I look at, let's say, the Fed, because you're right, they can price in the Fed in a number of different ways. But real money is buying vol out longer term. And, what does that mean? And that's the thing I'm wrestling with myself. And why they're bidding up this futures curve is such a steep contango. Not saying they're always right, but there is some cause for some concern longer term and into Q1 of next year, which to me is interesting because I guess they're looking at past as prologue. The last few years have kind of gotten out of the gate pretty hot. And so maybe they're thinking we're going to do that again for 20. I think we all hope not, but you never know out here. We'll keep going with these questions. You guys have more? Oh, go ahead. That's a great question. Crypto and the meme stocks do seem to go hand in hand. We do a show on a network called the Crypto Rundown, which is all about, to my knowledge, still the only show that kind of dovetails and details the derivatives activity in crypto, which is growing and huge. Still mostly Bitcoin, but as ETH is a big player now. Solana is starting to come on the scene in terms of having actual options volume. And you're right, there is a huge overlap between the two. A lot of people have started calling crypto kind of a high beta tech allocation, because that's where it is. That's the question we always get is, where does crypto fall in your portfolio? And for a long time, it was, well, it's this weird uncorrelated asset, and you can put it in as a diversified tool. I think that's gone away. The same people who are playing in these meme stocks are all, the Venn diagram is pretty much one. They're all playing in crypto as well. So these things move one-to-one. And so we have seen, interestingly enough, as you mentioned that, we was talking about the meme paper that we've seen coming back. We have also seen a resurgence. We track the skew in a lot of the major crypto, so Bitcoin, ETH, and some others. They were just extremely negative 30 or so when it got down to the midst of the sell-off in mid-June, when we hit the real nadir, when Bitcoin broke below 20,000, when ETH was threatening and breaking through 1,000. We saw extremely negative skew, which is weird. That's aberrant for crypto. Crypto is usually very analogous to a lot of it. That's for me. Just tell them I'll call them back in a little bit. Yes, exactly. Oh. If that's the case, then I am not here. I'm not available. But yeah, so crypto is usually very call skew heavy. And so it's kind of like a commodity in that sense. People want to load up to the upside. So when it got negative, that was pretty interesting. And for the last month or so, it has been slowly making its way back. It is now somewhat flat. We were hoping this week it might actually break into the positive. Didn't quite get there, at least as of our show yesterday. But it's about a negative 1 or 2 now. So that shows the calls are starting to get back in. If you look at open interest perspective, open interest, all anybody wants is the calls, which is interesting that the skew is still so flat. But in terms of Bitcoin, it's about 2-to-1 calls over puts right now. And ETH, it's insane. It's 4-to-1. So it's all ETH has had. If you've been watching the crypto space, ETH has had an explosive up move. Bitcoin's kind of gently drifted up. ETH has really just been rocketing up north. It got below 1,000. Now it's threatening 2,000. I haven't checked where it is today, but it was threatening 2,000 at one point. So I think the first part of your question, I think there's a huge overlap between those two audiences. B, we have seen a commensurate resurgence of interest in the call. So I guess if you want to put the two together, if you say maybe the memes are back, then are the crypto kitties, call them what you will, are they back? Then they are, skew-wise and open interest-wise, it does start to seem like the answer is yes. Another good product you guys can watch to see this for yourselves on the equity option side is Bito. Have you guys watched Bito? Have you guys been tracking that one? Are you looking at the skew? Watch the skew in that one, ticker symbol BITO. Is it up there? Oh, there you go. So you get way ahead of me. And the skew in that one is a great synopsis of how people are looking and playing Our buddy, Mr. Matt Amberson, is on our shows a lot. He loves Cboe. He loves the skew. He's always getting into 1x2s, and he gets himself into fun and trouble out there, but it's a great one. So if you're looking at a great proxy for what's going on for the skew and the overall level of interest, it's also a very liquid name. The ADV is north of 60,000, so it's putting up some numbers. So it's not like it's an aberrant name, only does 3 contracts a day, so the skew is kind of meaningless. This is real flow there. So if you don't have access to crypto flow, crypto analytics, which, by the way, a great platform to use to look for that is a platform called Genesis Volatility, GVOL. It's just gvol.io, gvol.io. They're kind of like a live vol or something else like that, an analytics platform, a trade alert. It's exclusively for crypto derivatives. So it's really cool stuff. I think they have some free stuff. You can go check it out. If not, tell them I sent you. They'll give you a free trial over there to look it out. But it's a cool thing. If you're interested in that in more detail, you want the skew, they do great average at the money across all the term structure. They look at skew in a different way. They look at skew not just 25 delta, but they do the whole strip from 30 to 20 delta. So you kind of see a nice holistic view of what the skew is shaping up out there. So it's a pretty interesting thing. I recommend you check it out. Dan, I've been talking for a bit. You got anything you want to add on crypto, sir?
I want to touch on one of the first things that you mentioned when we began this conversation. I think that the audience who trades meme stocks as well as crypto, they happen to be the same people, the same demographic, avatar, or whatever you want to say. But they're very different things. I think it's just because culturally, crypto is a very new technology, and the same people who are on Reddit and who are instigating some of these short squeezes from like a social perspective as opposed to a profit perspective, which is what I think we're more interested in. I think it happens to be the same people, but they're not the same product. As far as crypto goes, I would be hard pressed to even call it cryptocurrency anymore. I think when it started out as Bitcoin, it was this concept for just an anti-fiat currency, just the people's currency. But it just changed into something that is different than that. When we got so many different coins out there, it got to the level of absurdity, because anybody could launch one of these coins. But many of these coins have found a practical technological use, and that is to help put Web3 on the map, to enable websites and different applications to do things that you can't do without cryptocurrencies. So it's not a currency anymore. It's a product. It's a product that has utility, that has a practical value. And any cryptocurrencies that are out there, I'm making air quotes, and I know nobody can see this except people in this room.
Works very well on a podcast.
Yeah. But all these cryptocurrencies, how's that? You could hear the air quotes then.
You can hear the irony, yes.
Yeah. All these cryptocurrencies that don't have a utility for Web3 are worth zero. They're just simply worth zero. And the ones like that you can build things on, like Solana and Ethereum and that kind of thing, like those, they have an actual intrinsic value. And we're still figuring out what that is, but they do have an actual like physical value in the world.
Like ETH these days, it's at least north of 1,000, because it flirted with 1,000 briefly, then it got right back north of it again. So yeah, ETH, Solana, you're right. The big battle has been ETH versus Solana of late. It does seem like a lot of the other stuff, because at the height of the madness last year, you're right, there was a project hitting a day. People were hitting us up all the time to get on our crypto show with all these insane things. It does seem like people have coalesced now around a handful of things that have some fundamental utility to them. And of course, Bitcoin, which has no utility yet, but it's just kind of the volume leader still, right? So why not? All right, let's get out to. If you guys have more questions, feel free to raise your hand. We have questions here too. We can go. Oh, go ahead.
I've noticed that in some stocks, you can get good trades regardless of IV. Why is that?
What do you mean by a good trade? Like you looking to buy premium, sell premium, or
sell? Yeah,
sell premium. Okay. What's your tool you're using to analyze the IV? That'd be the first question I would probably put to you. When you say not great IV, what does that mean? So you're a premium seller, and you're able to get a fair amount of overall premium, at least an amount that you think is worth the risk, almost regardless of implied volatility. Is that what you're saying? I think part of that. I think Apple and NVIDIA, those are two interesting examples, because they don't tend to have huge IV swings. first you thought you're talking about maybe like a Carvana or some of these other weird ones that are, they could go from, 15 to 300, overnight. Compared to that, Apple and NVIDIA are kind of somewhat stayed. You kind of know what you're getting when you go into those. It's kind of like writing options in Ford, right? You know what you're getting. You're not going to get an explosive amount of juice, but if you know where you're lining up, you kind of know what you can expect. I think Apple and NVIDIA fall into that category. I mean, they're pretty active. Don't get me wrong. Apple's obviously topping our most actives. NVIDIA's usually in the top 10 somewhere in any given day, usually around 4 or 5. So they do a fair amount of paper. But you're right. They're kind of in a pretty steady vol range. Dan, you trade a lot of Apple. What are your thoughts on the fact that he could still get consistent premium returns almost regardless of where the vol is?
Well, keep in mind, there's no absolute levels for implied volatility. Like 60 can be a low volatility and 30 can be a high volatility. It's not absolute. It's like if you are going to buy a car, whatever, that's a $40,000 car, and they're trying to sell it to you at $65,000. Like, that's overpriced. It's over what it should be. But if you're trying to go buy a $80,000 car and they're selling it for $60,000, that's underpriced. So it's relative to many different things and not an absolute term. So, maybe that's part of what you're observing. It's just that you're able to get these these overpriced options in names like Mark's talking about, where they happen to be stable. They don't have a lot of historical volatility.
The reason why I asked what tools you're looking for, too, because one of the ways I tend to define vol in terms of an outlier, it's a very basic tool, but I think it's a great tool for everybody to use. It's just a simple volatility cone. It shows you where you are, where the current level of implied volatility is, and then where could be whatever you want, 30, 60, whatever metric you're looking at, and then how it compares to historical. So are you one standard deviation above the historical average? Are you one standard deviation below? These are some very basic frames of reference you could use to say, hey, maybe I shouldn't be selling premium here because I'm actually, if you look at historically, I'm one standard deviation below where, the vol usually is in this cycle. And there's a lot of context that has to go into it. You have to look at the time of year. I mean, the vol is going to be a little bit different around earnings time than it is, let's say, right now, middle of August, when not much is happening. I think a simple tool like that, a lot of platforms will give you access to a volatility cone now. If you type in whatever name you're looking at, an Apple or NVIDIA, you could see kind of exactly where your premium level is lining up compared to historical. Other tools, we're here in the Cboe, so the Trade Alert will do that for you too, where they will tell you where you fall in the vol percentile of what you're trading. Is it the 99th percentile? And maybe you want to trade it. Maybe you also want to be careful. At that point, you might go, maybe it's 99 for a reason. But if you're selling like a 12 percentile, then maybe you also want to keep your powder dry. So I think a tool like that could help put that level of vol you're selling in frame of reference. It's very basic. It's widely available. And it's not talked about enough, I don't think, because it can really help put your premium selling in perspective. Sometimes it's better not to sell. You're not getting the reward you want, But I think that kind of tool really helps people see in context what they're doing. Great question, by the way. Let's see. Let's go to this one here from Gray. He's been waiting for a little bit here. Gray. He has an interesting question. I don't think we ever had this question before, Dan. He says, can you guys explain what a call ladder is and why I would want to do one? We have never talked about ladders, I don't think, in all the long history of options. Maybe, correct me, maybe back in the primordial ooze days, I don't think we did, though.
Yeah, I don't think so either.
Call ladders, by the way, if you're not familiar with what a call ladder is typically, you're familiar with the butterfly, 1 by 2 by 1. This is kind of like that, but a little bit different in that you're buying one call. It's typically in the money. That's usually how they're set up. And then you're going to sell 2 calls against it, but you're going to sell one and then another one above it. That's why it's called a ladder. So you're going to buy one, you're going to sell another one, maybe somewhere around the at the money strike, and then you go another one farther out. So that's the typical structure of a typical long call ladder. I think we haven't talked about them on the show for a very simple reason. I'm not a huge fan of that structure. I think if you think about it intuitively, you could see why. It makes almost no sense to do these in an equity. I mean, when I do see these popping up more often, and we get asked about these, is on our futures option show. In the futures realm, it seems like ladders are people more into ladders there. I think for a couple of reasons. The skew is different in a lot of futures. So your commodities, your gold, they can tend to have a bid to the call skew, which you just don't see in equity. So in an equity, you're just selling 2 almost worthless calls. So that doesn't excite me at all. In a typical commodity, you could have a juicy skew that you want to take advantage of. Also, a lot of them are usually holding the future. So they have a future and then an in-the-money call and then 2 calls against it. So it's kind of a different flavor of the repair trade we were talking about before. The repair trade we liked that we talked about recently, listeners, is, of course, having the stock and then buying an in-the-money call and then selling 2 usually somewhere around maybe at the money or maybe slightly in the money calls, depending on your break even. But those are the same strike. You're not messing with the strikes on the short side. So I'm not a huge fan of these, which is probably why we haven't devoted an episode to in the almost 200 episodes. We've never devoted an episode to them. I don't think they make a lot of sense in an equity. In a futures option, I can maybe see an argument. Some of our guests have come on. They've tried to talk me into ladders. I've yet to be convinced. But Dan, what are your thoughts on call ladders, and do you see much utility for them, particularly in equities?
Yeah, I think it sounds like I share your thoughts on that. I don't see a lot of utility for it. I think people can get hung up on being fancy, and I like to keep it as simple as humanly possible. And when you're selling more units than you're buying, you better have a pretty good reason for it. And to me, selling two different strike prices seems and feels indecisive. What is your reason for that? If you've got a great reason for it, great. But if you don't, and you probably don't, then you're just getting fancy for no reason.
Yeah, I agree with you. It seems wishy-washy. Pick your strike if you want to sell it. If you don't have the underlying, then you're just doing naked short units, which is another reason why we haven't talked about on the show. We don't want to put people out there. Look at last year. If you did this trade last year in most of the underlyings we talked about, you're out of business now. You're done. That's it. You have naked short units. You were blown. If you did this in a GameStop or an AMC, forget about it. So yeah, this is not our favorite. Who was asked this? Gray. Not our favorite strategy. You guys, I'm assuming, are not call ladder fans here. But yeah, it doesn't make a lot of sense, particularly for the audience of this show, which is mostly equity options trader. Interesting question. Maybe, I guess if we get more questions on it, maybe we could devote a full episode to why we don't like them, but slamming ladders for a whole half hour. We got more questions here, but if you guys have any more, they're doing all right here. Let's go. This is along the lines of what you were just asking. It's a question here from, I like this handle, Angry Alpha. So he's getting alpha, but he's angry about it. I don't know. You should be happy. Happy alpha. He says, I've been selling SPY 7 to 10% out of the money puts every 2 to 3 months and collecting a fairly decent income stream from them. Is this a smart strategy, or am I setting myself up for disaster down the road? Oh, well, it sounds like he's angry, so maybe he should be happy. His strategy is working out. We've talked about selling puts a legion of times on this show, Dan, right? And we're fans of it. It makes sense, especially if you do that basic step we always say, which is if you identify that level, if you're selling puts at levels where you're happy to buy SPY, then you should be happy. If you're doing it cash secured, you put aside the cash, you're okay with the opportunity cost you're missing out, because you have to have some capital to do this, and you're okay with not just buying your SPY outright, then this sounds like a perfectly reasonable strategy. I don't know, 7 to 10% on the money. I mean, it sounds like you don't think you get a lot for those, but it sounds like he's happy with what he's getting. So you should be. I'm going to say you should be happy, Alpha.
We've talked about this a number of times on the show. We kind of talked about something similar to this here in the Mastermind, but it's kind of your frame of mind that's important. And if your frame of mind is, hey, man, I don't know, I just sell these every 2 or 3 months and it works, and I just keep making money, and I'm just going to keep doing this forever, then in that case, I'd say you are setting yourself up for disaster. But if you're looking at it as, like Mark was saying, a cash secured put, and I actually do want to get assigned if it goes down to this level, this is part of a longer term investment strategy or a longer term, wheel or recycle trade strategy, then that's great. If you're picking your spots, you're picking the stocks that you want to do it in, and you're not just okay with getting assigned, you want to get assigned because that's part of your long-term strategy, then that's great. Keep doing what you're doing. But if you're just like, hey, man, I don't know, it just keeps working, I'm just going to keep selling, then that can end up putting yourself in a dangerous situation.
Yeah, be happy with your trades. It sounds like you're doing all right. So we talk about psychology on the show, right? If he's angry all the time, then what are you doing? What are you doing? And what's the point? All right, let's get out of here on this one here, Dan. Let's have one last chance here. Anybody feeling the ropes? All right, we're good here. Let's go here to this one last. Good.
It seems to be out there a lot lately is the Elliott wave.
We've talked about technicals before. Dan, you're more of a technical guy than I am. I had a lot of my technical analysis love beaten out of me when I was on the floor trader, and I'll just give you a quick reason why. Because when you're doing that, you end up doing a lot of gamma scalping. I'm sure you've explained to people what gamma scalping is, and so that was a lot of what the business was back then. Intraday, You're sitting there, have some deltas, and you're hung on them, and you're going to watch the underlying go up. You hopefully have some long gamma. You could scalp it there, and then hopefully you're going to buy it back intraday. And during that time, we tried just about every technical indicator you could think of, from the low-hanging fruit of your Fibonacci's and everything along those lines, all the way to extremely esoteric things. Now, granted, this was a very short frame of reference window. We wanted intraday, right? So not all indicators are going to work for that short of a frame of reference. But for what we were doing, we found very little utility in anything outside of the most basic, widely held stuff, because that's where everybody was lining up, right? Because everyone knew what a Fibonacci was, and everyone could run it even at home on their simple terminals back then. You'd see a ton of orders lining up at the book at those levels. So go figure, the stock would kind of bounce off that level or would kind of gravitate toward, depending on what we were seeing out there. So the low-hanging fruit stuff tended to work. I used to joke when we were on the floor, like, you could make up your iceberg and lettuce indicator, and if people follow it, it's going to have some utility for you, right? So that kind of beat a lot of my intraday kind of technical analysis. Dan's trying to lure me to the dark side, I think, a little bit more. He's been middlingly successful, but maybe, Dan, are you more of a fan of Elliott Wave than I am?
You know, I read up on Elliott Wave many, many years ago, 20 years ago, and as I understand it, I'm sure if I misunderstand it, one of our listeners will mail into us, and we can have a fun discussion next show. But it's based on a principle of this idea that all things sort of happen in this predictable waves that are part of a wave of nature. And it's not just stock prices. It's like, you know, social upheaval, fashion trends, innovation that can all be predicted by this sine wave sort of thing that is based off, if I'm not mistaken, the number phi or something like that. And, you know, it seems a bit mystical when you look at it from this big picture sort of thing. But I'm not ready to poo-poo that or anything else just yet. I mean, could there be something to that? Sure. But I personally don't use it at this time. So yeah, I would like to see a little bit more physical evidence, you know, besides, there's just this magic number that leads to a sine wave type thing of ups and downs that we can predict.
Have you tried the iceberg and lettuce? It's pretty good. I've had a good history.
Yeah, no, but I had some homemade Thousand Island on my Reuben today from Manny's. I don't know. Me, when I use technical analysis, I don't use it to predict the future. And we talked about this today, too. I use it as a map of past human behavior to make educated decisions about the future based on the past. So any technical analysis indicator that purports to predict the future, I have a little bit of a hard time with. And if somebody finds that there's something out there that works, please, email me personally.
Have you had good success with it? Is it working out for you?
I'm not using it.
Okay, just kind of testing the waters. Yeah, well,
it seems to be.
If it works for you, that's great. You can be like happy alpha guy here, like having a good time with it. Don't let us rain on your parade if you're having good. I'll send you the links to the iceberg and not iceberg lettuce, icebergs and lettuce. You have to put the two together. That's what makes it a little bit more esoteric, but it's a good one. All right, Dan, we'll get you out of here on this one. This one comes in for you. This goes from Monkey 3K. So he's got 3,000 monkeys. He says, Dan mentioned on Options Bootcamp that a covered call and a short put are the same thing if they are done from the same strike. Does that mean that they aren't risk equivalents if you do the same strategies, but from different strikes? I think this was on the last episode, Dan. We were talking about call put parity. We mentioned you have to be from the same strike. It sounds like Monkey 3K is a little bit confused, sir. What do you have for him?
Yeah, so right. If they're the same strike, they're synthetically equivalent. So, I'm looking here at, I've got BITO options here pulled up. It's trading at 1448 right now. If I owned 100 shares of them and I sold the 16 calls to create a covered call, then, okay, that's a covered call. And you can picture the upside-down hockey stick P&L drawing of that. But if I didn't own the shares and I sold the 16 puts, which in this case would be in the money, which is typically not how you sell puts, cash secured, it would have the same risk reward. It would have that exact same upside down hockey stick drawing that the covered call would have. They would have the same risk, only the timing is different. With the covered call, I buy the stock and I sell the option, and after expiration, I'll either still have the stock or I'll sell the stock. If I sell the in-the-money put, I don't have the stock now, but after expiration, I'll either get assigned and buy the stock or I still won't have the stock. Either way, it all works out the same. But when I use different strike prices, it's a little bit of a different scenario. It would be the same if I use the 15 calls and the 15 puts, or the 14 calls and the 14 puts. But if I'm talking about the 16 calls and the 14 puts, it's different. The best thing to do, I'll tell you what, using put-call parity in your daily trading is not a thing. But understanding put-call parity to make your daily trading better is a fantastic thing. So I highly encourage you to read up on put-call parity, you 3,000 monkeys.
All right, Dan, that music means we've come to the end. Another epic sojourn through the world of options boot camping. Great questions, everybody. Great questions everybody who wrote them into. I love doing this with a live audience. We'll do it again in front of New York. Live people get to the juicy. Maybe we'll get some good questions when we go to New York and do the panel there, Dan. But before we go, if folks are intrigued, maybe they want to come to your next mastermind here in person. Where should they go? What should they do?
Yeah, we'd love for you to come to markettaker.com. You can join free and get some great classes, particularly great for newcomers. We offer our chat room for free right now, and we'd love to have you and help you however we can.
There you go. Check them out. Markettaker.com is the place to go to learn more. Of course, you know where to go for all the rest of our content listeners, theoptionsinsider.com, and click on that pro link if you want to join us. Listen to live Heckle Dan Live in the live show there and everything else we do here on the network. Options Oddities and, of course, Options Bootcamp. Great pro Q&As there as well. You can check out all sorts of fun stuff and more. theoptionsinsider.com/pro, or for you cool kids out there, /secret club. Back again a little bit later today for Options Playbook Radio, and then, of course, throughout all the rest of our schedule, and then back again next Education Wednesday, another episode of Options Bootcamp. Stay safe out there.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.